or a bullish inside candle. This illustration shows that the most recent candlestick in a bullish harami will usually be bullish, but there can be exceptions. In this chart, we have the 1 hour time frame of the S&P futures. I have marked the range of the last two candlesticks in the same way I did in the previous example. Observe how the range of the current candle is contained within the range of the previous candle, therefore creating an inside pattern. Price was going down, so this is a bullish harami pattern, meaning that price will be going down and then the pattern will appear to signal a reversal to the upside. Let's see what happened with price right after the pattern. In this chart, you can see how price immediately reverses to the upside after the bullish harami or the bullish inside candle. The next candlestick pattern I want to talk about is called shooting star, and it's a bearish reversal pattern that is also very common and very reliable. Since it's a bearish reversal pattern, it appears when price is going up in order to signal a reversal to the downside. The shooting star is made of only one candlestick, so we have to pay attention to the specific properties of this candlestick. The shooting star has a small bearish body, a large upper shadow, and a non-existent or very small lower shadow. This is a bearish reversal pattern because the candlestick opens, then goes to the upside at some point during the formation of the candle, as it is shown by the large upper shadow, and then price closes lower than the open. All of this means that price went up a little bit and encountered powerful sellers in its upper range. In this chart, we have the 4 hour time frame of Bitcoin versus the US dollar. I marked a clear shooting star pattern after price has been rising for a while. In this next chart, you can see that the price went down immediately after the appearance of the shooting star pattern. The bullish version of the shooting star is actually called hammer, and it has a small bullish body, a large lower shadow, and a non-existent or small upper shadow. The interpretation is the opposite of the shooting star. The candlestick opens, then goes to the downside at some point during the formation of the candle, as it is shown by the large lower shadow, and then price closes higher than the open. All of this means that price went down a little bit and encountered powerful buyers in its lower range. In this chart, you can see the 5-minute time frame of the US dollar versus the Japanese yen. As you can see, I marked a classic hammer formation after price has been going down. In this next chart, you can see how the hammer indicated a reversal to the upside with good accuracy. Notice also how I'm giving you different examples in different markets and different time frames, so you can get used to the fact that these patterns work in the same way in any price chart you analyze. Another powerful candlestick formation I want to show you is called the outside candle, also known as the engulfing pattern. This is the opposite of the harami or the inside candle in a way. This is a pattern formed by two candles. The main characteristic here is that the range of the second candle must engulf the range of the first one. The pattern indicates that price will go in the direction of the engulfing candle. In this outside formation, a bullish candlestick will engulf the range of the previous candlestick, as you can see in this illustration. In this image, you can see the 5-minute time frame of the Canadian dollar versus the Japanese yen. Notice that the current candle has a range that completely engulfs the range of the previous candle. And also, the current candle is bullish, implying that there will be a reversal to the upside. Immediately after the engulfing pattern or the outside candle, we can see that the market started to go up. We also have the bearish version of the engulfing pattern. In this illustration, you can see that a bearish candle completely engulfs the range of the previous candle, therefore indicating a reversal to the downside. In this image, you can see the 45-minute time frame of the German index. Notice how the range of the current candlestick completely engulfs the range of the previous candle, and how the current candle is bearish, indicating a reversal to the downside. In this next chart, you can see how the bearish engulfing pattern or the outside candle indicated a reversal successfully. As I said previously, these are just a few examples of what candlestick patterns can do. And if you want to dive deeper into the subject, you can watch the other video I created entirely dedicated to the subject. Notice that we began analyzing the elements of an individual candlestick, then we moved on to patterns formed by one or two candles. The logical step here is to learn what happens when we broaden our view of the price chart and observe the patterns formed by collections of candlesticks. This leads us to the idea of highs and lows. Anytime you open a price chart, two things become obvious right away. You notice that there are candlesticks in the chart and that these candlesticks form peaks and valleys or highs and lows. Your ability to recognize these highs and lows is essential for most good trading strategies out there. For example, take a look at this chart. There are around 160 visible candlesticks in here. And notice how distinctive highs and lows form as new candlesticks are formed. It's always useful to mark these highs and lows, as you can see in this next chart. If we mark the highs and lows and then erase the candlesticks from the price charts, you'll be able to see how there is a certain structure in the market. Being able to identify highs and lows in the price chart is important for a few different reasons. 1. You can establish the overall trend of the market by looking at the highs and lows. 2. You can identify what are called support and resistance lines. 3. You can identify chart patterns. 4. You can detect the strength behind price movements by comparing highs and lows in price with the highs and lows in certain technical indicators. Don't worry if you don't know what all of this means, because we'll talk about each one of these 4 elements right now. Let's begin with the overall idea of market trends. We have basically 3 types of trends that can happen. The bull market or uptrend, which is when prices are going up. The sideways market, which is when prices are moving sideways or in lateral motion. And the bear market or downtrend, which is when prices are going to the downside. We can detect each one of these types of trends by looking at what highs and lows are doing in the price chart. Let's first observe what happens in a bull market or uptrend. In an uptrend, prices rise because buyers have more power than sellers, so the upward price movements are larger than the downward price movements. This creates the main characteristic of uptrends, which is the presence of higher highs and higher lows in the price chart. Higher highs mean that buyers are strong enough to create progressively higher levels in the price chart. Higher lows mean that buyers are progressively starting the new upward price movement at a higher price. In this chart, you can see a real example of a clear uptrend or bull market. Notice how there are higher highs and higher lows throughout the entire trend. The next type of trend will be the sideways market, which is characterized by roughly equal upward and downward price movements. This means that buyers and sellers have around the same strength. The sideways market is marked by flat highs and flat lows, as you can see in this illustration. In this chart, you can see a real example of sideways market. Notice that in real charts, the flat highs and flat lows are not perfect. What matters the most here is the overall aspect of highs and lows. In a downtrend or bear market, the sellers are more powerful than buyers, so the downward price movements are larger than the upward price movements. That generates the characteristic effect of downtrends, which is lower highs and lower lows, as you can see in this image. The downtrend is basically the mirrored image of the uptrend. In this chart, you can observe a real example of downtrend or bear market. Notice once again the lower highs and lower lows as the main characteristic in here. This finishes off the overall idea of trends by looking at simple highs and lows in the price chart. We can now move on to a different use of highs and lows, which is to help in the identification of support and resistance levels. Support and resistance levels are horizontal barriers in the price chart. These barriers can be useful for identifying reversal points in the market. When price is below a barrier, we call it resistance. In this chart, you can see an example of resistance. The first high sets a barrier for price, and then when price comes back to this level, it treats it as resistance, only to reverse to the downside right after. When price is above the barrier, we call it support. In this price chart, you can see an example of a support line. Notice how price touches the line 3 times, and then it reverses to the upside. In other words, the support line acted as a barrier. When this barrier is strong enough, price reverses direction after hitting it. You identify support and resistance lines by connecting highs and lows together with horizontal lines. There are 2 important properties of support and resistance lines. 1. The greater the number of times that price respects a support or a resistance line, the stronger the barrier. 2. Support and resistance lines have a switching quality, meaning that a support line that is broken becomes a